Alright everyone, Cowboy Trades here and welcome back to the channel for another update on the stock market. So, the stock market, the global economy, your cryptocurrency markets, all of your markets in general are currently witnessing a credit crunch. What does this mean for the SP 500? What does this mean for Bitcoin? Let's talk about this in today's video. Now, before we dive into some more of the complex charts, complex topics, a brief fundamental lesson. What creates these bear markets and what creates these bull markets? Well, it is the accessibility of credit. When credit is very, very cheap, you can see this at the bottom of the screen when interest rates are historically low. This is what creates a lot of borrowing in the economy. Borrowing allows people to go out, borrow money, spend that money in the economy. That boosts businesses. People also borrow and invest in the stock market. And this is what creates what is known as credit booms. You can see interest rates are low, credit boom, interest rates are low, credit boom. What happens opposingly when the interest rates are set very, very high? Well, everything's very expensive. Things are expensive to invest. It's expensive to borrow, and subsequently people either don't have the money to or they prefer to save that money, and that is what creates what is known as credit contractions. When the interest rates are extremely high, credit is expensive to get, and this is what creates credit crunches or credit contractions. So now we've talked about the very basic fundamentals, let's dive into some slightly more complex topics. At this moment in time, the net percentage of domestic banks tightening standards for commercial and industrial loans is heavily increasing. So as we discussed before, when banks are doing lots of lending in the economy, when interest rates are historically low, this is what creates these boom cycles. So right now, this chart shows us that banks are tightening their standards of who they're willing to lend money to. Now you can see previous tightenings have happened coming into the 2000 financial crisis. Tightening came into the 2008 financial crisis. There was tightening coming into the March 2020 Black Swan event, and there's also tightening happening where banks at this moment in time are becoming far more picky with who they are looking to lend money to. So it's no surprise to see that the banks' tightening standards are also in high correlation with the interest rates, because if banks wanted to lower their tightening standards, they obviously want to encourage people to borrow from them to cause the economy to boom. So low interest rates often correlate to low banks tightening standards. Now, what's interesting about this chart is that the United States interest rates always lead the way. You can see over here in green, the interest rates, when the interest rates start to come down, this is typically, a leading indicator for banks tightening standards to come down and accommodate for this as well. You can also see when the interest rates start to raise like they did in 2004. It took about a year or so for banks tightening standards to also increase, but you can see these soon followed suit. You can see low interest rates correlates to low tightening standards, and high interest rates like we're seeing right now also correlates to high tightening standards. But we do sometimes see some divergences in this chart. For example, over here, we saw a huge divergence where interest rates were coming down, but banks tightening standards went up. This was because of the March 2020 Black Swan event, but over here in 2008 we didn't have that same Black Swan event. So what happened? How come the interest rate started to lower in April of 2007 to encourage borrowing, but the bank's tightening standards went on a massive rally? Well, we can find the answer to this in our next chart, the delinquency rate on credit card loans. The delinquency rate is basically a fancy term for saying people are defaulting on their loans. For example, if you borrow £10,000 from the bank and you tell the bank, hey, I'm going to pay you back in monthly installments of £1,000 a month for a set amount of months. If you default on that, you don't pay back your loan on time. So let's say you default for a month, you default for 3 months, or let's just say you leave the country and you say, hey, I'm never paying back this loan. You will be becoming delinquent on that loan. So when the delinquency rate goes up, it shows us that people are not paying back their loans on time, or they're not paying them back at all. So right now we're seeing the delinquency rate once again go up, and we'll discuss the delinquency rate going up at this moment in time a little bit later on in this video. But you can see this huge spike in the delinquency rate coming into the 2008 financial crisis. So this is why when we plot these two together, when we look at the bank's tightening standards and we compare this to the delinquency rate, once again, these do have a strong correlation, and also they have a strong correlation to the interest rate. So this chart over here, the delinquency rate explains why the interest rate came down in 2007 into 2008, but the bank's tightening standards continued to increase. Just like we saw over here, this is because while the interest rates were going down, the delinquency rate was going up, so banks were tightening their standards of who they were lending to. And just very quickly before we move on to our next topic, you can see that the United States interest rates, the bank's tightening standards, and also the delinquency rate all have a pretty strong correlation between each other. So let's discuss the delinquency rate a tiny bit more. Is this going to be continuing its trend of 2022 and increasing? I personally do think so. Now, this data updates quarterly, and we currently are waiting for our Q1 2021 reading. Now, we are actually seeing the net percentage of domestic banks. We've had the reading for this in Q1 of 2023. This has followed its trend in 2022. Banks are tightening their standards, but we haven't had an up-to-date picture of what's happening in the delinquency rate. As we've discussed in previous charts, it makes sense for banks to tighten their standards if the delinquency rate is going up. So this is one cause for concern, potentially saying that the delinquency rate will once again be going up. And looking at a broader picture of the delinquency rate, let's look at credit in general for consumers. If we move on to our next chart and look at consumer loans for credit cards and other revolving plans, this basically shows us credit card debt. We are looking at this credit card debt. This is updated very frequently. It's updated weekly. You can see that coming into March, this has once again hit a new all-time high. Credit card debt in the US is constantly going on a massive parabola. So at this moment in time, we have high interest rates, we have high delinquency rates, and we also have banks tightening their standards. So it's no surprise to see that the credit card debt has hit an all-time high, and with credit card debt hitting an all-time high, we've got the commercial bank interest rate. The interest rate on which people pay back their credit card loans has absolutely skyrocketed up to a new all-time high, 19.07%. Now, the interest rate on credit card plans basically follows the same path as the interest rate in general, and this is why it's such a worrying picture. A lot of the times when the interest rate took a huge run to the upside, it was not too long until the delinquency rate started going up with it. So this is definitely not a good sign for this quarterly reading for the delinquency rate. I once again do believe that we are going to see the delinquency rate continue with this trend to the upside. This is going to cause higher interest rates, which we're already seeing. This is also going to see higher banks tightening standards. And once again, tying back to our original thoughts, tying back into what allows the markets to move into these boom territories, it is cheap credit. And it also depends on the accessibility of credit. Credit needs to be cheap and credit needs to be accessible for all to create these boom and bust cycles. If the interest rates are high, if banks are tightening their lending standards, if the delinquency rate is going up, this is going to cause all of these tightening standards for credit to increase, and we're going to continue seeing a credit contraction into 2023. So in this video, we talked about how cheap credit is required for credit booms. We also talked about how expensive credit leads to credit crunches, also known as bear markets. Now, when we tie everything we've talked about together, the interest rates are currently going up. Because of this, the delinquency rate is going up. People are defaulting. And because of this, banks are tightening their standards of who they are lending to. This all creates a broad picture of a credit crunch. Credit is extremely expensive right now and harder to get than it was in previous bull markets. So because of this, because the delinquency rate is up, because tightening standards are up, because the interest rates are up, because credit card debt just hit an all-time high, and because the interest rate on credit has just hit a new all-time high, this is not good for the stock market, and this is why we're likely going to continue following the trend of this credit crunch into 2023. Those are the main topics that I wanted to talk about in today's video. I do also just want to highlight, if we are looking at the book debt for the SP 500, basically this is a tool to visualize liquidity, visualize the readily available credit in the market. You can see the liquidity is draining from this market right now. This blue line in the middle shows us the mid price or the SP 500 price. And as you can see, as liquidity drains from the market when credit becomes more expensive, the price of all of your markets in general breaks to the downside. Now, talking about Bitcoin, if we switch this S&P 500 chart over to Bitcoin, Bitcoin has only known what it's been like to live in a credit boom cycle only recently. If I clear up this chart, we have only recently gone into expensive credit territory. Right now, credit is the most expensive it's been in Bitcoin's entire existence, and you can see as the interest rates have been going up, the Bitcoin price has been crashing. This is what a lot of people who do Bitcoin analysis kind of refuse to acknowledge. They think Bitcoin lives in its own bubble. At some point in the future, that could be the case, but for now, Bitcoin follows the general markets, Bitcoin follows the equity markets, and Bitcoin follows the general picture of credit. If credit is expensive and hard to get, then people are not investing, and less people are going to invest in Bitcoin when credit is very, very expensive. Just look at what happened to the Bitcoin markets when credit was extremely cheap coming into March of 2020. The interest rates were basically set at zero, and because of this, everyone was borrowing money. People were borrowing money and rushing into the cryptocurrency markets. People were using stimulus checks to rush in and buy up these markets. So once again, just a warning sign, Bitcoin is going to follow what the stock market does, and the stock market is going to follow what the general picture of credit is doing. Credit is very, very expensive right now, and it's hard to get, so expect further continuation, expect further bleed outs for the S&P 500 and your Bitcoin markets. And the last thing I want to talk about is credit in the banking system itself. Now, most banks are running out of credit. We've just seen that Credit Suisse is going to be taking up a loan of $54 billion from First Republic because it is running out of liquidity. We also quite recently saw that Silicon Valley Bank has collapsed after running out of available liquidity. A lot of people went to withdraw their money, causing a bank run. This is the problem with fractional reserve banking. If you put £1,000 in your bank today, they're only going to keep a small amount of that money, and they're going to go and invest the rest of it. If they make poor investments, if they invest in the stock market, if they invest in low yield bonds and then the bond market goes up offering higher yields, the stock market starts to crash, they are going to run into a liquidity problem. And when people go and withdraw their money, this is what causes bank runs, this is what causes liquidity crunches, and this is what will further tighten credit further down the line. Once again, raising delinquency rates, raising bank insolvencies, raising banks tightening standards, raising the interest rates, and crashing the market. So for today, my friends, that's all I've got. Just wanted to provide my opinion on what's happening right now in terms of credit, how this will affect the S&P 500, and how this will affect your cryptocurrency markets. If you do enjoy my content, as always, let me know down below by leaving a like and a comment, share the videos with your friends. If you want to further support the channel, feel free to come and click the join button and become a member today. Come and follow me over on Twitter at 618_cowboy. But I'm going to leave it here for today. Spin your boy Cowboy Trades. I'm out. Peace.